Forex Focus brought to you by IG, taking a look at the 10 most important economic calendar events to trade. You've got so many data points at your disposal these days, not just US economic events, but what's going on in the Euro area, what's going on in UK, Japan, China, of course. The last several years, their data points are becoming more and more relevant to our US market and the global market, obviously, as well. And so wanted to zero in on what at this current moment seems to be some of the most important data points. But first, let's just talk about what an economic event is and why it might be relevant to your trading. These are largely public releases of information with the potential to affect market prices. And these can have, more specific effects like a stock's earnings, obviously. Essentially just affects that stock. It might affect other stocks in the sector, but you usually wouldn't have an Apple stock earnings affecting, for example, the exchange rate between the euro and the dollar, or interest rates in the US, or crude oil prices might not be affected by that. And so while it's a valuable piece, that Apple earnings to Apple trading, the 10 most important economic events usually are ones that have sweeping effects, not only over Apple stock, but the entire stock market, the currency market, the commodity market, the interest rate market. And here's just an example. Recently, we had a non-farm payrolls, which will be on the list. We'll cover it in a second. And that event comes out, and the euro dollar market jumps immediately off of that event. This is a 15-minute chart, and you can see the information comes out, and the information leads to a euro rally against the dollar from where it was trading 106, around 106.50, gets all the way up to 107.50, 100 pips of movement in that day from this economic event. And so you can see the relevance here to your trading. And there's a bunch of these events that are the most high priority ones are usually US data releases. And here with our list, you can see that almost all of them are US data releases. We've got, the FOMC meeting where the Fed announces interest rates and comments on the economy, non-farm payrolls that we just highlighted as an example, CPI inflation, Fed chair speeches, the European Central Bank meeting, very, very important as well. And then you have PCE inflation, a lesser known inflation measure, retail sales, GDP, manufacturing, PMI, and then also Chinese data has become so essential over the course of the last several years. Now, the importance of these events absolutely changes all the time depending on market conditions. For example, inflation numbers were just not important for a handful of years because inflation was between 0 and 2%, which is normal. But recently, in recent years, inflation has been so high that those data points are very, very important now. And another example, the Fed, for a handful of years when inflation was low, they weren't changing interest rates. So FOMC events weren't necessarily the most important pieces because you would tune in and they would be like, yeah, we're keeping interest rates at 0% the way that we have for the last several meetings. And so this stuff changes all the time. This is our curated list of the top 10 events currently. And let's dive in and give you one, a definition, but also two, when they tend to occur. And FOMC meetings are a little bit funky in that they only occur 10 times per year as scheduled. They can hold impromptu, unscheduled FOMC meetings like they did when the pandemic hit. They actually had 2 meetings in March to cut interest rates because it was an emergency, right? The economy was seeing something that was unforeseen. But as it is scheduled, they meet 10 times per year. So every around month and a half, And they, one, set the overnight interest rate benchmark here in the United States, but two, they also comment on the economy. And this has become really important, is the press conference after the fact and the dot plot and all these different informational pieces for where interest rates might be going in the future after they actually set the interest rate itself. And here is that dot plot that kind of projects where the Fed central bankers are thinking interest rates will be in, the next year, 2 years from now, and in the longer run. And this has obviously been much more important as interest rates have been moving over the course of the last couple of years. And this affects, of course, all of these events, just as a quick aside, have tiers to them. And this, as you might imagine, the first tier is the interest rate asset class, right? But from there on out, interest rates hugely influential over Forex markets. And from there, hugely influential also over stocks. Interest rates can affect how, much growth a stock might see in the future. If interest rates are high, it's going to be harder for a growth-oriented stock to finance that growth. And also, companies that deal with clients that have to take on debt to buy a house or a car, they might be affected adversely by high interest rates, as well as they might be affected in a positive way by low interest rates. So many effects here, tiered action to each of these events, but the FOMC meeting, definitely the highest priority item recently. And then from there, non-farm payrolls also very, very important. And this is essentially just the employment data point that comes out first Friday of every month here in the U.S. from the U.S. Bureau of Labor Statistics. And this might make sense if you think about it from the standpoint of, okay, well, if the central bank, if what they do is, let's say, the most important piece here, then given that they act off of theoretically two data points, the central bank is usually looking at, they're looking at a ton of stuff, but primarily they're looking at inflation and they're looking at employment. Then you would expect that employment data is very important as well. And this non-farm payrolls is, one, going to tell you what the change in the unemployment rate is, and two, it's going to tell you the change to just jobs. Have we grown in jobs month over month? Have we lost jobs? Are there less jobs, more people becoming unemployed than employed in the last month? And those are two valuable pieces for the Fed's action. And then, as you might expect, inflation also important, given that that's what the central bank looks at. The CPI inflation is the consumer price index that is reported by the U.S. Bureau of Labor Statistics. And you can see why it's been so valuable the last couple of years here. Between 2010 and 2021, it was sitting right there between 0 and 2%. And that's where the central bank likes it, is at 2%. But in the last 2 years, it's skyrocketed up to close to 10%, has since come back down. And now everybody kind of holding their breath, wondering, are we going to stay here around 2% or is it resurging once again? But yeah, employment, inflation, essential for the Fed. And there again, the Fed's influence is so big that at number 4, you have Fed chair speeches. Now, these can be really hit or miss because you never know what's going to get touched on. But that being said, Jerome Powell will usually speak 1, 2, 3 times a month, depending on his schedule. And as you might imagine, given our recent high interest rate environment, he gets asked all the time, what does the economy look like? What are interest rates looking like for the foreseeable future? And any kind of tipping of his hand to what they might do at the next FOMC meeting, very valuable. So maybe not as valuable as an FOMC meeting itself, but Fed chair speeches can be indicative of where the Fed might be heading at their next meeting. ECB meetings also have become very, very relevant to Forex markets and U.S. interest rate markets, and that can from there sway stocks and everything else. Because a lot of times what you'll see. The European Central Bank also meets at least 10 times per year, and they set their euro area overnight interest rate and comment on the euro area economy. But what you'll see a lot of times is central banks kind of moving interest rates higher and lower together. And so you might have an ECB meeting the week before an FOMC meeting. And if they hike interest rates or they, come out surprisingly dovish or hawkish, they're going to do something that maybe the market wasn't pricing in or anticipating. That might move U.S. markets, with the idea being, oh, well, if they're moving interest rates in this direction, then the Fed is likely to follow suit. Same vice versa. If the Fed is doing something, a lot of times that'll get priced in Europe as well. At number 6 here, you have the PCE inflation data, which doesn't garner as many headlines as CPI, but Fed Chair Powell does always make a point to say that PCE is his preferred measure of inflation. And it's just a different calculation of inflation, because at its core, inflation is just the percentage change for prices of goods and services. And so different places can price those goods and services in different ways. They can include energy prices, they cannot include energy prices, so on and so forth. And this is from the U.S. Bureau of Economic Analysis. But there, on a monthly basis, you have two inflation measures that are very important, and right there give you two kind of monthly events that can be tradable and very relevant to your trading. Here, retail sales. This is one that actually recently has started to garner more interest. Retail sales has upticked a little bit recently, but actually amid the inflation conversation, inflation has kind of taken the top spot, and retail sales has become a little bit less relevant. But this is one that can pick up steam, especially if retail sales numbers, which are the change to retail and food services sales on a monthly basis reported from the U.S. Census Bureau, if these numbers do start to climb and get higher than a percentage point, let's say, this will become a more anticipated event and could move. Its first tier would be stocks, but also interest rates and Forex as well, a valuable piece there. And then GDP growth is, you might say, Frank, how is GDP not the most important number? Because it is kind of the one that you learn about in economics classes and everything else before maybe an inflation or an employment data point, because it's the gross domestic product of an economy. And the only reason is because these numbers, one, they're quarterly numbers, although monthly forecasts are reported from the U.S. Bureau of Economic Analysis. But two, they tend to be kind of slower moving numbers. The GDP growth rate in the U.S., for example, as you can see here, has been 0 to 1%, 2%, 3%. And so, whereas non-farm payrolls, for example, we've had numbers that were expected to be 150,000 jobs and have come in and been 350,000 jobs. And so you get more volatility, whereas GDP can be less volatile and thus kind of have less to take from on a monthly or quarterly basis. Manufacturing PMI, this is another one similar to retail sales that can be really important if this number is far away from 50. As you can see recently, it's been at or a little bit below 50 the last couple of prints here. But this is a number that essentially reports how the manufacturing part of the economy is doing. And if it's over 50, it can mean expansion. If it's under 50, it can mean contraction, and thus have an effect on stocks and also indicate where inflation might be heading. So have an effect on interest rates and Forex as well. Now, lastly, and this is kind of a catch-all, I cheated a little bit on this one. Chinese data in general has become so relevant to the U.S. economy and global economy over the course of the last 5 to 10 years. Especially numbers like trade balance that let you know how the Chinese economy, which has become such a big part of our global economy, if they're doing well, then that kind of leads to an expectation that the U.S. and the rest of the global economy might be doing well as well. When they're doing poorly, a lot of people might take that as an indication of, oh man, we might see a global economic slowdown because there is so much importing and exporting, so much dependency throughout Asia, Europe, and the US on that Chinese economy. And so you're going to want to be tapped into those data points as well. But there you have it, the top 10 most important economic events on your calendar to trade.